Do you want to discover the 5 top secrets to wealth building from the legendary investor, Warren Buffett? In this video, we'll dive deep into the strategies that have made him one of the richest people in the world. Learn how to apply these principles to your own financial journey and unlock the path to financial freedom. Don't miss out on these valuable insights. Hit the like button, subscribe to make rich money, and let's get started. Number 1. Psychological preparedness for long-term holding. Warren Buffett's counsel regarding the importance of psychological preparedness for long-term holding in the world of stock investing underscores a vital yet often underestimated aspect of financial success. This advice reflects the profound understanding that successful investing isn't just about financial acumen. It's also about emotional resilience and discipline. Investing in stocks, especially with a long-term horizon, demands a level of psychological readiness akin to owning a farm or real estate property. Just as a farmer must patiently nurture crops and wait for the harvest season, an investor must be prepared for the ebb and flow of financial markets over extended periods. One of the key attributes required for this psychological preparedness is patience. Patience is a cornerstone of wealth creation, but it can be challenging to cultivate in a world that often prioritizes immediate gratification. Long-term investors must resist the allure of quick riches and the temptation to frequently trade in pursuit of short-term gains. Another crucial element is emotional resilience. Financial markets are inherently volatile, with prices subject to fluctuations driven by various factors, including economic cycles, geopolitical events, and market sentiment. Investors who panic in response to market downturns or constantly react to short-term price movements often find themselves making suboptimal decisions. Warren Buffett himself is a shining example of this psychological fortitude. His success can be attributed not only to his financial acumen but also to his unwavering commitment to his long-term investment philosophy. He is known for holding stocks for decades, even during market turbulence, and this approach has contributed significantly to his wealth. In conclusion, the psychological preparedness for long-term holding is an integral part of successful investing. It involves developing patience, emotional resilience, and a steadfast commitment to one's investment strategy. By aligning financial goals with psychological readiness, investors can navigate the ups and downs of the market, remain disciplined, and ultimately achieve their long-term financial objectives. This aspect of Buffett's wisdom serves as a valuable reminder that successful investing is not just about what you know, but also how you approach the journey. Number 2. Distinguish between investing and speculating. Warren Buffett's clear distinction between investing and speculating lies at the heart of his investment philosophy. It's a fundamental concept that sets the tone for successful wealth creation and is a critical aspect of his teachings. Investing, according to Buffett, is the act of allocating capital to companies that possess solid financials and robust business models. This allocation is not done haphazardly but is driven by a careful assessment of a company's fundamentals, including its competitive advantage, earnings potential, and long-term prospects. The primary goal of investing is to reap compound returns over an extended period, allowing wealth to grow steadily over time. In stark contrast, speculating is a different beast altogether. Speculators are not primarily concerned with a company's fundamentals or its long-term viability. Instead, they engage in a form of gambling, betting on short-term asset price fluctuations. Speculative activities often involve higher risks and are characterized by a focus on quick gains, driven by market sentiment, rather than a deep understanding of the underlying assets. Warren Buffett is a staunch advocate for investing and a vocal critic of speculation. He attributes much of his success to a disciplined investment approach that emphasizes long-term value creation. By concentrating on companies that have the potential to thrive over the years, Buffett has consistently built substantial wealth without succumbing to the allure of short-term gains. The peril of speculation, as Buffett underscores, lies in its unpredictability and the tendency for high-risk behaviors. Speculators often fall prey to the emotional roller coaster of market sentiment, buying in a frenzy during bull markets and selling in panic during bear markets. This kind of behavior rarely leads to sustainable wealth creation and can often result in significant financial losses. In conclusion, Warren Buffett's wisdom regarding the distinction between investing and speculating is a crucial lesson for aspiring investors. It serves as a reminder that successful wealth creation is rooted in a disciplined, long-term approach that prioritizes sound fundamentals and the potential for compound returns. By differentiating between these two approaches, investors can chart a course that aligns with their financial goals and minimizes unnecessary risks. Number 3. Price versus value. Warren Buffett's enduring success as an investor is deeply rooted in his unwavering commitment to the principle of distinguishing between price and value. This fundamental concept is one of the cornerstones of his investment philosophy and is critical to making informed and prudent investment decisions. Investing, in Buffett's view, is not about merely buying stocks at their current market price. Instead, it's a meticulous process of evaluating a company's intrinsic value. Intrinsic value represents the true worth of a company, based on its financial health, earnings potential, and long-term prospects. To assess this intrinsic value, investors must conduct a thorough analysis of a company's financials, delve into its business model, and understand its competitive advantages. One of the key takeaways from Buffett's approach is the importance of conducting due diligence. This entails scrutinizing a company's financial statements, including its income statement, balance sheet, and cash flow statement. By examining these financial metrics, investors can gain insights into a company's profitability, debt levels, and cash flow, which are vital indicators of its financial health. Understanding a company's business model is another critical aspect. Buffett advises investors to consider whether a company possesses a durable competitive advantage or economic moat that sets it apart from its competitors. This moat can take various forms, such as strong brand recognition, cost advantages, or network effects. Businesses with enduring competitive advantages are more likely to maintain profitability and deliver consistent returns over time. Moreover, Buffett's investment philosophy encourages investors to remain steadfast in their commitment to intrinsic value, even in the face of short-term price movements and market sentiment. Market prices are influenced by a multitude of factors, including emotions, speculation, and external events. As a result, they can deviate significantly from a company's intrinsic value in the short term. In conclusion, Warren Buffett's emphasis on the distinction between price and value is a fundamental lesson for investors. It underscores the importance of conducting thorough research, understanding a company's fundamentals, and maintaining a long-term perspective. By adhering to these principles, investors can make more informed and rational investment decisions that are aligned with their financial goals. Number 4. Embrace market downturns. Warren Buffett's perspective on embracing market downturns is a testament to his long-term and contrarian approach to investing. Contrary to popular sentiment, Buffett views a decline in stock prices not as a cause for concern but as a significant opportunity. In Buffett's eyes, a drop in stock prices is akin to a sale at a grocery store where your favorite items are available at a lower cost. Similarly, when stock prices decline, it presents investors with an opportunity to acquire more shares of companies they believe in at a discounted price. This approach encapsulates the essence of value investing, which focuses on buying quality assets when they are undervalued by the market. It's important to understand that investing, according to Buffett, is a long-term endeavor. In the short term, financial markets are subject to fluctuations influenced by a multitude of factors, including economic cycles, geopolitical events, and market sentiment. These short-term fluctuations are part and parcel of the journey for investors and should not detour them from their long-term goals. Buffett's own investment track record reflects his willingness to embrace market downturns. He has consistently held onto stocks even during periods of market turbulence, demonstrating a remarkable ability to remain unfazed by short-term price volatility. This steadfast approach has paid off handsomely, as the companies he believed in have often rebounded and generated substantial returns over time. Moreover, Buffett's philosophy emphasizes the importance of being a contrarian investor. When the market is gripped by fear and uncertainty, as during market downturns, prices of quality assets often become unduly depressed. By having the courage to swim against the tide and buy when others are fearful, investors can potentially position themselves to reap the rewards when sentiment eventually turns positive. In conclusion, Warren Buffett's perspective on embracing market downturns is a powerful lesson for investors. It underscores the wisdom of viewing declining stock prices as opportunities rather than threats. By maintaining a long-term perspective, having conviction in your investment thesis, and being willing to go against the herd, investors can harness the potential of market downturns to build wealth over time. Number 5. Avoid frequent trading. Warren Buffett's staunch advice against frequent trading is founded on a deep understanding of the pitfalls of emotional reactions to market volatility. He firmly believes that engaging in frequent trading, driven by emotions like fear and greed, is a detrimental practice that rarely leads to long-term wealth creation. Buffett's philosophy, instead, encourages investors to adopt a patient and disciplined buy and hold approach. Frequent trading, often triggered by the fear of losing out or the desire for quick profits, can be a perilous path for investors. Emotional reactions to short-term market fluctuations can cloud judgment, leading to impulsive decision-making that is often counterproductive. These emotional reactions can result in buying high during market euphoria and selling low in moments of panic, precisely the opposite of what successful investing entails. Buffett's wisdom extends to the futility of trying to time the market. Market timing involves predicting when stocks will reach their lowest or highest points, a feat that even the most seasoned experts struggle to achieve consistently. Attempting to time the market often leads to missed opportunities and increased transaction costs, eroding potential returns over time. Similarly, chasing hot stocks or following the crowd is a strategy that rarely pays off in the long run. Stocks that are currently in favor may have already reached their peak and be poised for a downturn. Investing based on short-term trends and market sentiment can result in disappointment when the momentum inevitably shifts. Instead, Buffett's approach champions the idea of buy and hold. This strategy involves purchasing quality assets with a long-term perspective and holding on to them through market ups and downs. The buy and hold approach aligns with Buffett's belief in the enduring strength of the American economy and the long-term growth potential of well-established companies. In essence, Warren Buffett's counsel to avoid frequent trading is a call for discipline, patience, and rational decision-making. It underscores the importance of maintaining a long-term perspective, avoiding emotional reactions to market gyrations, and focusing on the fundamentals of quality assets. By adhering to these principles, investors can increase their chances of achieving long-term wealth creation and financial success.